Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the SALT Conference in New York City. Joining us for this segment, we have Krubiner. He's the co-founder and CEO of Pagaya. He's here to discuss breaking down the consumer credit market for institutional investors. Gal, it's great to have you with us. Welcome to Trade Talks.
Thank you so much, Jim. Happy to be here.
You got it. And how has the emerging crisis among banks impacted institutional funds exposed to consumer loans and credit?
So I think the crisis that we are experiencing in the world of the banking is actually an interesting topic, especially when it comes to consumer credit. When you're thinking about the main way Americans day to day are getting financed, their auto loans, their consumer credit, their banks, their credit cards, it's usually coming from a mid-sized bank. So that was a really big part of the ability to drive the funding in the US. And as we all know, the US, the private sector in the US is responsible for 70% of the GDP, right? So it's a major part and a major part of the economy. Now, when you think about that in a little bit of a broader context, it's very clear. Going to be less credit available for people. It's as simple as that. When big banks are experiencing the thing that they are experiencing, from a liquidity perspective, from holding their things on the assets, their willingness to lend is becoming much lower, and they are closing and tightening their ability to lend for these products that are so essential for Americans to live with and to live by. And the interesting part that we have seen actually from 2008, when that same thing happened just in the bigger banks, is that other capital, such as institutional capital, find its way to overcome these hurdles and to provide credit to the Americans and to all of the different auto loans and consumer credit, etc. And the fintech from that perspective, and Pagaya is part of it, is really representing the opening door of the institutional capital in exchange of what the banks used to do. Now, obviously, it's not one-to-one,
right.
And the banking industry is so crucial for the US economy. But if you will look on it over time, there is a bigger share of what is being funded through institutional capital, through different asset managers that back in the days were sitting on the balance sheets, on the deposits of the people. And that shift is going to continue to happen.
Yeah.
I hope that will drive to the better availability of credit, and then institutional capital will be able to stand out and to be able to provide all of that. But this is the shift that we're going to see.
Well, I mean, you need the capital for the economy to grow. To your point
100%.
before, our GDP is 70% consumer. If you turn that
100%.
off, then we don't grow our GDP. Tell us about the growth of consumer credit as an asset class. What are the macro factors that impact investor behavior in that space?
So consumer credit is a very interesting character. If you will ask the regular investor what is the size of the consumer credit or how big is that asset class in his own portfolio, you will figure that in most of the places the percentage is very, very small. Instead, for example, in high yield bond or other parts of corporate credit that are very well known. But the fact is that from size perspective, it's even bigger. The full consumer credit in the US could be like it's something around $4 trillion. We have almost $1 billion in the personal loan. We have like above a trillion in auto loans. And all of these asset classes, because historically came from the banks, are less known to people who are investing in portfolios from the institutional capital. And one of the things that I think we found fascinating in Pagaya is to allow that access to become more seamlessly. And how you're taking institutional capitals, anywhere from endowments to pension funds, all of our saving money in different shape and forms, insurance capital, and allowing them to have an easy way to go into these markets. And to make the statement and understanding that the size of this market is actually much bigger than the corporate world, a fact that most of investors are less familiar with.
How does Pagaya enable asset managers like GIC, which is Singapore's wealth fund, to invest in consumer credit?
So GIC is one of the most sophisticated investors that years back understood the size of that asset and actually progressed and opened dedicated desks and dedicated specialists to be able to invest in the ABS space and in the consumer, in the mortgages, and in all of that unique asset classes. What we are doing with GAC, the way we're enabling them is we are allowing them to utilize our network AI. Just for a background, Pagaya network is connected to many lenders in the US that are providing consumer credit for the people. So we have partners that through them we are enabling and allowing people to get credit. Now, that flow of funds, the ability to fund these loans, is usually coming from institutional capital. And a GAC alike that wants to invest in the billions every year, he needs to have a trusted advisor. He needs to have a partner. And it happens to be that in that world, machine learning and AI is the best way to validate the risks and the opportunities. So while GAC connecting to our network, to our AI network, they are managing to distribute and to get exposure to many different lenders and asset classes, from auto loans to consumer credit, utilizing a very strong centralized AI capabilities.
Let's talk about AI for a moment here. Why are funds created with the assistance of AI? Why are they attractive for institutional investors?
So the AI has, if you want to think about it this way, it has much bigger predictive power. So the ability to ask the question, who is going to pay?
Right.
Are you going to pay me back? If I'm going to give you now a loan, is it 100% certain? Is it 70% certain? Obviously what you try to do is to provide credit to people who has the ability to pay back. So you want to know that A, they have the historical kind of like fundamentals of the belief that money should be paid back when you take a debt. And the second thing is the means. They have the right salary and the right attitude for that. What the AI does, and the importance of it, is to take a very big amount of data, historicals of millions of payment that has been done on millions of Americans, and trying to give the better analytical capability to predict if you're going to pay your loan or not. Now, the beauty about it is two sides are actually enjoying from it. GAC and the investors, because they get a better return, and we have been outreaching our benchmark by far every time. And on the other side, when you think about the economy, you do want to reward people who are paying back, so they will have in the future lower cost of capital, while you want to make sure that the people who are not planning to pay back are going to be excluded from the system.
Right.
So the AI are some kind like of a high-level regulator that knows to distribute the funding to the people who are more deserve to get that, regardless of what was their FICO or very high-level type of like stigma.
Yeah.
And it's really, are they good borrowers? Are they going to pay? And that's the power behind it.
Yeah, I mean, you'd think the banks would employ AI when they're thinking about their different risk scenarios that could have probably helped some of these regional banks avoid it. Why do you think Pagaya is better positioned than many other fintechs, both in this macro environment that we're experiencing and in fintech overall?
So the cool root of that is being the centralized piece. So think about a lender. A lender is usually seeing the flow and the situation that he is getting from the borrowers who are coming to ask money from him. When you're sitting as a centralized network, you're actually seeing the requests from many lenders. So on our network, we have more than 25 different partners. So when we're seeing a phenomena with one versus the other, it's very quick for us to understand if something bigger is happening in the economy because the inflation hits people in a different shape and form, or any other metrics, or it's just a specific thing that happened in a specific partner. So the unique position that Pagaya is sitting in the middle and enjoying from getting the data from over 25 different partners is giving us an incredible power to react quickly. And in days like we're experiencing right now, with a banking crisis, with inflation going so high, with interest rate catching up, to be able to be nimble and to react quickly is the name of the game. So being that in the center with a strong eye and a mission to help people is kind of like the best way to leverage and to utilize the AI to take advantage of the changes that are happening in the world to be able to direct them to the right investment opportunities.
Gal, we appreciate the insight. Thanks for joining us on TradeTalks.
Thank you so much, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.